Thursday, December 12th, 2019, Maneco 64, home of alternative economics and contrarian views. So the Federal Reserve decided to keep rates unchanged yesterday. The dollar index has broken key support. And why is that? Well, the Fed basically promised that they will increase QE if necessary. They will extend QE down the yield curve to longer durations, to coupons, as Jay Powell said. So I read an article the other day talking about the problems in the repo market, and they mentioned a Hungarian guy who's done a lot of work for the Fed in '08, now works for Credit Suisse. He basically said JP Morgan's been front running the QE since the beginning of this year, maybe late last year. And what does that mean? Well, they've been buying treasuries, longer term dated treasuries, in the expectation that these treasury prices will go up, and then they can sell it to the Fed for profit. So that's what's going on, front running by JP Morgan of treasuries. How did that impact the repo market? Well, JP Morgan used a lot of their cash reserves to buy these treasuries, so there wasn't enough cash in the repo market. So the Fed knows this. So and the Fed knows that this system is broken, that if they stop inflating like they did when they're doing QT and raising rates, everything will implode, right? Yesterday they said they're not going to cut rates anymore in 2020. They might do it in 2021. But last year, as I've said many times, they're talking about raising rates this year. So I will bet that they will cut next year, at least once. Maybe even two, three times. Who knows? Maybe even 4 times the Federal Reserve will cut rates next year. We just have to see the stock market get under pressure, and they'll start talking about cutting rates again. QE is definitely in the cards. It's already in the cards. They're already doing 60 billion of T-bills. That's why the dollar index went down. Precious metals did well. The stock market is going to probably remain quite firm. It doesn't seem like the Federal Reserve wants to let the stock market go down. Of course, they're not perfect, the Federal Reserve. They don't have, they're not all powerful, as I said, to keep things going, but we'll have to see right now if the market still buys it. So this morning, let's look at what the Fed said. Let's look at an FT article here from the Fed, what Jay Powell said specifically in his press conference. Sometimes I listen to these press conferences, but to be honest, listening to it is very frustrating because it's like listening to a Soviet commissar during the Soviet times, communist times, talking about the economy, right? We all know that central banking, centralized credit is one of the planks of the Communist Manifesto, right? So central banking is not about free markets. And I would say MMT as well is not about free markets. So when people ask me, oh, do you think MMT is good? I say no. QE nor MMT are any good. They are against free markets. They're a centralized form of credit and money, right? In a free society, we need competition, free markets. We don't need central banks. We don't need MMT. Governments are just there to administer the rule of law. Governments have never invented anything in the markets. Money is a creation of the market, right? So we need to leave it to the market. But anyway, let's see what the Fed said here. The important part here was that it says in September, when the Fed last published its predictions, the median policy rate proposed for 2022 by participants in the Fed's open market committee was 2.4%. That has dropped to 2.1%, right? It also says here, the decision to leave rates as they are what was widely expected by markets, but the shift towards more confidence in the labor market paired with the plan to continue to hold rates below their 2018 levels for several years show a central bank that is shedding its traditional fear of inflation and shifting its focus toward continuing to support the U.S. labor market. Unlike previous meetings, which saw multiple Fed officials push back against the rate decision, there were no dissents. So they're using this phony argument that inflation is too low, right? That they can keep rates low for a long time. They can do QE. Well, they haven't gone out into the real world. They haven't spoken to the general public who sees their cost of living rising and rising. More like at 5, 6, even 10%, right? The other day I was in a shop, grocery shop, and I saw a can of baked beans, Heinz baked beans, just a regular baked beans, and the can was half the usual size, and it cost 69p. It was 200 grams. Then you look at the normal can, 415 grams. And that's 85p. So the price there is almost gone up like 60%. The shrinkflation is getting even worse. So that there's an anecdotal evidence as well. The other thing I would say, listen to the Wolf Report on YouTube. Wolf Richter, he talks about hedonics, which is how they lower prices of goods through the years by including the improvements they have. For example, they will take out £1,000 from the price of a car because the car has more gadgets, right? It has airbags instead of not having airbags maybe 20, 25 years ago. But he notes that the general public, their wages haven't gone up. So yes, the improvement has taken place and the car is worth more, but people still can't afford it, right? And that's how they lower the CPI, but it doesn't really make much difference for the general public. So that's what I would say here. But my take from yesterday, and we'll look at the charts in a minute, is the dollar index. It looks like, yes, I've spoken about this, that the dollar index made a top in January 2017, and I continue to see it going lower up until 2023, 2024. And yesterday it broke some key supports. So let's have a look here. This is a daily chart, and this is going back to the beginning of this year. So you can see here we've broken a head and shoulder formation. We've broken the neckline. So where's the next target, in my opinion? Well, short-term target would be 96. Right, in the dollar index, which would be near the lows of the last 9 months or so. And then you look at the longer term picture, which I've spoken about, that high there in January 2017 at 103.82. I think that will be a long-term high. As I've said before, doing the cycles work, dollar index cycles last between 7 and 9 years. So average about 8 years. So I think up until 2023, 2024, we won't see another high above that level. And as you can see here, 96 is a very key level. That there will be some support there at 96, but once it breaks that, I think it could accelerate lower. Of course, gold has outperformed the dollar index even since the dollar index made a low in March 2008. Gold was just over 1,000. Gold is now almost 1,500, right? So gold will continue to do well no matter what, but this will probably help gold along as well. And as I've said before, for people who want to hedge fiat currency debasement, like we're going to see, continue to see from everywhere around the world, the right way to do it, in my opinion, is through precious metals, not through jumping from one fiat currency to the other, right? That's a mistake, in my opinion. So it's 8:15 a.m. London. Let's quickly see where the markets are this morning. Spot gold is at 14.73, is down $1.50. The range has been fairly narrow, 1472 to 1476. Silver, we got up, I think, just below 17 yesterday. Right now it's down 1 cent at 1684. The Dow futures up 38, 27,946. S&P 500 is up 5 at 31.45. NASDAQ 100 futures up 15. Currency, sterling is still fairly firm. Today, of course, we have the general election. Do I really care much about it? Not really. I don't think either side of the political spectrum, things are going to continue as they are. More currency debasement, more government spending. Of course, if Labor get in, which doesn't look like they will, I think things will accelerate. It could actually be a blessing in disguise for those who want to see the system flush down the toilet, right, and reset. But anyway, Euro firm, of course, above 111 now, 111.36, only up slightly overnight. But as I said yesterday, the dollar index moved down quite a bit after the Fed decision and the press conference. Dollar, yen, 108.62, so back below 109, and the dollar yuan is fairly steady, 703. WTI crude is up 0.25%, 58.78, and Brent is at 63.56. So we haven't seen much move in the crude oil or energy market. The 10-year yield yesterday did drop about 4 to 5 basis points, but we're back up a little bit here. We're back up about above 180. We're at 181. Yeah, there's no end in sight, unfortunately, for this inflation. And by that I mean the real kind of inflation, the creation of money and credit out of thin air, right, by the central banks for the benefit of the financial sector, of the banks, of debtors, right? And for savers, it's going to continue to be really tough out there. So if you enjoyed this video, make sure you hit the like button, subscribe to the channel if you haven't yet. Please share this video far and wide. And you can also follow me on Twitter, Steemit, and on DTube. I wish you all a great day. Take care. Bye.